everyone, a very good evening. You're watching The Money Show on ET Now with me, Mubina Kapasi. This is a part of our ET Now Rise with India Prime Time segment. And as always, The Money Show is dedicated to making you wiser with your money habits, be it investing, saving or spending it wisely. But looking at today's market, I'm sure it spooked quite a bit of you, especially with the Nifty falling, almost about 400 points in just a day. The Sensex as well has lost close to 1,100 points. And as mutual fund investors, if you will switch on the television, you will wonder, what are the implications? Because I have money in the markets. The question, of course, that arises is, how worried should mutual fund investors be, whether they are equity mutual fund holders or debt mutual fund holders? Well, to assuage all of these fears, that's going to be the whole aim of today's episode of The Money Show. Let me introduce our guest for today then. It's Dilshad Billimoria of Dilzer Consultants. Dilshad, thank you for joining us on this episode of The Money Show. It's not surprising when, individuals switch on the television after coming back home, from a day of work, whether they are doctors, teachers, lawyers or any other profession, and they see the carnage on the market and they see the Sensex has crashed, the Nifty has crashed, and then they wonder that, okay, I'm invested in the markets because I have equity mutual funds and I do my SIPs. So what does it mean for me? So Dilshad, for all our mutual fund investors, should they be worried about this big crash that we are seeing in the markets?
Good evening, Mubina. So as we can see, this is more of an event-driven risk. It's because of the coronavirus, which is a very unfortunate event. And as we speak, actually, this epidemic is increasing across many countries. As always, when it's an event-driven risk, I think the best thing is to hold your investments and let it pass, because ultimately fundamentals are what matter. And I would consider this as a good time actually to invest, considering that prices have fallen and NAVs are low. You would be buying more units, so it's always good to invest now as an opportunity for long-term investment.
Okay, so would you recommend, Dilshad, then that they should make calls to their their managers, their money managers or their brokers and say that, what, if I'm doing a SIP of, let's say, 10,000 rupees now, I want to increase the SIP to 15,000 rupees. Would now be a good time to do that? Because, it's literally like the whole market is on a sale of sorts.
Absolutely. More than SIP, I would say ad hoc investments would make more sense now, because you're trying to, of course, you can't time the market, but you're trying to make sure that you buy more units and you don't know when it would fall again. So if you have any lump sum monies, I think it would be a very good time to spread it as and when you see a fall.
Okay. All right, so a fall is always a good time to make some investments in the market, because you'll actually be able to buy your investments at a lower price. So that definitely does get a thumbs up. Now, Dilshad, it's not just equity markets that have actually been falling. We've seen a fall even in bond yields. And, fixed income is always a bit of a more complicated topic compared to equities. So what should an investor do with a movement in these bond yields when it comes to debt mutual funds? Because while equity mutual funds we keep and hold for the long term, debt mutual funds are still there for that, for us to park our money for the short term. It could be as low as maybe a month to as much as maybe 3 years. So for them, to strategize the market, to time the market of sorts, becomes a bit more important. Would you agree with that?
Mubina, I would say that investing in a debt mutual fund should follow the YTM methodology. So if you are, having a time horizon of say 3 years, I would ideally pick a debt fund which has an ITM which is equivalent to that period. So that's typically how one would choose a debt investment. If it's a liquid or a liquid plus investment, as you mentioned, a 1 month time horizon, then again you would be investing in a selection of funds which meet the YTM requirement. and it's not very tax effective, I would say, to invest in debt for the short term. So I would still stick to the mandate and the objective of the fund before deciding very carefully the investment option.
So right now, let's put the context right now. Growth is not good. The economy is not doing very well. We have inflation that may be making a comeback. So we could be seeing that, central banks around the world, the RBI and all, will be cutting interest rates. Bond yields are anyway falling. So at this juncture, which debt fund would be most poised, most well set up to essentially do well?
I would go with debt investments at the shorter end of the yield curve because they are more cushioned against any interest rate changes. We are not sure and not certain that there would be a interest rate reduction which would happen in the next credit policy. In the last two credit policy announcements, there was no interest rate reduction which was announced. So it's a wait and watch situation as of now, I would say. But if investors would like to shield themselves against interest rate risk, I think staying at the shorter end of the yield curve would make more sense.
Okay, all right, fair enough. It's not, like we've been saying, right? It's not just Indian markets that have actually seen a big fall, but even globally as well, equity markets have seen a big fall. And if you look at the last 1 odd year, there's been a nice bit of outperformance that has come by in what we call as international funds. You have, say for example, the Motilal Oswal Nasdaq fund or the Franklin India US feeder fund. All of these essentially, as the name suggests, do have stocks from global markets. How important is it to ensure that you have an international fund in your entire basket of portfolio?
That's a good question. We would normally recommend an international fund purely from the asset allocation point of view, and we would normally suggest between 5 to 7% of one's portfolio is allocated in international funds. Investing in an international fund just because it's done well in the last 1 year is not, the future performance would not be repeated as it is in the past. So although the Nasdaq and the S&P 500 have given above 20% plus returns, our BlackRock and Mobius and HSBC have actually, thought that the coming year would be for emerging markets. So it's important to look at asset allocation and then invest, rather than looking at past performance and then making a decision to invest.
So 5 to 7% roughly of your entire portfolio could go into international funds, just for the purpose of adding that bit of diversification. And of course, Dilshad, when we talk about diversification, how can we not talk about gold, right? Especially because now I think it's just at about that 42 to 43,000 per 10 grams. And this as well is a great diversification tool, especially now, markets are falling, but gold is doing well. So how would you recommend at this point of time, our viewers use gold in their portfolio to sort of cushion themselves against the fall? Or do you think that now it's perhaps too late and it doesn't make sense to go out and buy a gold ETF or a gold fund at this juncture when it's already so high?
Right. So again, that would be based on the asset allocation, and we again here would recommend between 5 to 10% in a gold ETF investment. Considering that gold is a hedge against volatile markets, so it's like your currency, it's a hedge against volatile markets. So I would definitely say consider gold, and consider adding a part of that to your portfolio through a gold ETF investment, and it would actually protect and provide an overall average return when equity markets are very volatile like it is now.
Okay, I just want to also talk to you about the recent SEBI notification that essentially allows investors to buy and sell units via the exchange directly. Is this basically like, when you use the direct method of buying mutual funds? I mean, what do you make of it? How would it benefit our viewers today?
Well, it's too early to state what actually impact it would have. It's just a notification, but I think it would definitely ease the method and the transaction process of investing in mutual funds. But money management is much more than that. So it involves, actively managing the portfolio, reporting it to your investors, and providing rebalancing and asset allocation as per the goals of the client. So I think just merely providing a transaction platform would definitely ease the mode of investments towards mutual funds.
All right, okay. Dilshad, I'll request you to stay on with us. We will slip into a very, very short break right here on The Money Show. But when we return, we'll help you with your personal finance related questions, how you should navigate this sell-off. Like Dilshad says, don't worry, be patient. And in fact, if you have some surplus cash, why not use this big sell-off to buy in a little more? But Ask The Money Show is a segment that we will be bringing on board right after this short break.